You have long and existing relationships with the likes of Blackstone, KKR, and Apollo. Why take a different approach?
Well, we're going to continue those long-standing relationships well into the future. What we're doing, CalPERS has a 7% rate of return requirement, as we've talked about quite a number of times. Private equity is an essential component of our asset allocation in order to meet that target. It is our highest returning asset class over the last 20 years, and going into the future, we believe private equity is an essential asset class for us to move forward. And as a result, we've developed a comprehensive strategy to invest in the private markets at scale. As you know, CalPERS has $355 billion of assets, and as we look forward to construct a private equity portfolio, we know we'll need to build a portfolio of scale, $40, $50, $60 billion private equity portfolio. So we need a number of tools in our toolkits in order to access the private markets.
Why can't you do that exclusively with outside managers? Why do you need to go direct?
Well, again, it has to do with scale. We don't think we can invest at the scale that we need to solely in the traditional offerings of private equity general partners.
Because of the fees?
No, just certainly just the size and the amount of capital that's pouring into these relationships. We're not able to build a $50, $60 billion portfolio solely through the traditional general partnerships. That's number one. Number two, there's some real advantages to CalPERS to design alternative business models in private equity. Namely, we have a very long-term investment horizon. We have liabilities that we're looking to pay and invest for over 40, 50, 60, 70 years. Many of the traditional vehicles that we invest in have much shorter horizons, and these alternate vehicles that we're announcing today are going to have evergreen, indefinite investment horizons, and that will allow us to match our liability stream much more directly.
You raise an important question. Why should any public pension plan, let alone CalPERS, with the kinds of long-dated liabilities you have, continue to invest as much as you do in public securities? 50% of your portfolio is in public equities. You just raised your fixed income allocation to 28%. And even though you might have tens of billions going into private equity, it's still a fraction of your overall portfolio.
Well, the public securities are essential to our overall
But you don't need the liquidity.
Well, we do need liquidity over time, and we get paid for that liquidity provision. So I can't imagine any scenario where CalPERS or an institutional investor of our size can achieve our goals solely through the private marketplace. As important as the private marketplace is, we have to be investors in the public marketplace. It's also very efficient. Remember, we've discussed this many times. We're able to invest for basis points in the public markets, and it's a very cost-effective, very efficient way for us to earn and meet our overall 7% rate of return. Ted,
is the outlook for returns improving or deteriorating?
Well, it's a challenging environment for returns. You know, we've had a great run, and we continue to have this rally, this long-term rally since the financial crisis continues. So we've had a great year. Our calendar year return is a little over 11%. But looking forward over the next 10 years, as a long-term investor, we see muted returns. We actually think our portfolio, which is heavily invested in equities, about 50% of public equities that you mentioned, and additionally our hope to get another 10% invested in private equity, even with those equity-centric investments in our portfolio, we're estimating about a 6% return over the next 10 years. So it's going to be a challenge.
You won't hit your target?
Not over the 10-year horizon. And as we completed our asset allocation work, we're really looking to years 11 through 60 for some normalization of interest rates and otherwise to allow us to make that 7% required rate of return.